Hello and welcome to Livewire Markets. I'm Ali Selby and today I'm lucky enough to sit down with multi-award winning portfolio manager James Abela, who looks after Fidelity's future leader strategies. Today, James will be sharing his secret to his strategy's success, as well as where he's seeing opportunities both locally and abroad. Thank you so much for joining me, James.
Thank you, Ali.
There's a lot of analogies in finance, but I've read in the past you've compared investment management to being like Robin Hood. Can you take us a little bit through that?
So the Robin Hood analogy really is about taking capital away or limiting capital to those that don't deserve it and giving it to capital to people that do deserve it. And for me, that's high quality companies, structural winners, industry leaders, companies that are being run well for the right reason, innovating for the world, changing the world, leading the world, etc. on the positive side. And on the downside, you've got like weaker companies, lower quality companies, poor governance. For me, it's also poor sustainability. And that poor sustainability has really become a very, very big theme, obviously, globally. So that talks to environmental awareness, modern slavery awareness, social consciousness, governance, gender diversity, fairness, capital allocations, and really doing, I think, what's fair and what's right. And that's where a lot of comments have been made now about where socialism or fairness has really become an intricate part of capitalism globally, and especially in parts of Northern Europe, it's become very, very important. And I think that the Robin Hood kind of analogy has come, I guess, full circle into the sustainability theme, and that is now, I think, a very, very big theme globally that is like quite a serious theme as well, because it goes into bond markets as well as equities.
Our readers really love small caps. Is it possible that you could provide, one or two practical tips that could help them succeed in this area? Yeah,
I'd say, look, the two big themes in small caps for me is owning the long-term winners, owning quality in those, what I call the beautiful compounders. It's like a long-term beautiful marriage of 20, 30 years where you're doing something very unique. So things like Seek or realestate.com.au or Fisher & Paykel or ResMed. And these companies are up 20, 30, sometimes 100 times over a 20-year period because they have very high quality businesses. They're doing something very different and they believe what they do in terms of viability, sustainability, credibility, and they hold that for decades. And that is... it's very unique to find those things, and for me, that's what you really want to try and spend most of your time on in small caps, especially Aussie small caps. Then the other side of it is momentum, which you can follow and you can chase, and you can make quite a lot of return from the momentum kind of profile of stocks, but you need to be very self-aware because it can get, basically too hot and too popular, which is really like called peak momentum, peak sentiment, peak earnings and peak valuation. And when you reach that peak, that's pretty much the end of the party and you need to leave before the market realises that was just a little party. So for
before the lights go on.
Before the lights go on,
Do you think we're seeing any of that now, or?
Well, momentum is a big driver of the market today, and I think you need to be really careful. The fact that like high risk, high beta, micro cap, concept stock, loss-making stocks, all these have been beneficiaries of the current environment, which is very, very unique. So you've had fiscal stimulus and monetary stimulus, which is, the last time this happened was after World War II. Interest rates are the lowest in hundreds of years. The attitude towards risk is erring on complacency. And you've got people using words like the everything bubble and bubble market. And like there's a lot of concern, I guess, about the fact that yes, there's a lot of momentum present in the market today. And you need to be, I guess, aware of that. That's why I'd say the long-term winners are the ones where you're sort of safer and can be longer term. And the momentum party is something that you can't participate in, but you need to be very, very self-aware when you do that.
We're in a vastly different world to what we were 12 months ago. Can you take us through how your portfolio has actually changed during that time and what was the turning point for you?
Yeah, very dramatic. So March 2020, pre-COVID, even February, it was really a case of being defensive with a quality skew. So it was gold, property, healthcare and technology were really the major drivers of the holdings of the portfolio then. That was great going into COVID as that market correction happened. The fund did quite well. And then the signals to start to move the defensives, move gold, move property, really started to happen, I guess, April, May and June, where the world started to really change a lot, and it was going really strongly towards the reflation and recovery theme, and the vaccines and all of that was very, very strong, movement by the whole world to drop interest rates and develop a vaccine, which we are at that point now. So the movement from that sort of defensive quality skew is now a lot more reflation driven. So reflation, recovery, but also still a skew to quality, because there is a lot of momentum and risk is very free and valuations are very high. The world is, as it's moved towards cyclicals, it's also moved towards duration. So you can't have, I want to be a believer in the reflation and the recovery, but I only want short duration. So the longer and longer you believe that is happening, the more and more you will actually go towards quality. So I think momentum and cyclicals have been very, really popular and strong, and upgrades and margin expansion and multiple expansion. But as that reaches a peak, I think that then you need to think about quality even more, especially like now and then towards the end of this year. And that's where the fund now is a blend between quality and cyclicality.
Yeah. Is there a topic that you and your team are spending, I guess, the most time discussing at the moment that perhaps the rest of the market is overlooking?
I think it's not an uncommon theme, and that is sustainable valuations is really what we are focused on as a team. What is a sustainable valuation in quality? So you've got stocks in healthcare and technology that are on 100 times PEs. That is a really high multiple, right? When the market's on about 20 times. So it's 5 times the market. So that's a big multiple, and you might be growing at 20%, and the market's growing at 10. So you're growing at double the market, but your multiples are 5 times the market. So that's a question mark in terms of quality. And then on the cyclicals or momentum or turnarounds or value, it's these things have run hard, and what is a sustainable valuation parameter? Because some of them have earnings growth, some of them have cyclical growth, and some of them have no growth. And you really need to break your mind up on, in a year from now, what is the sustainable valuation for this business, whether it is 0 growth, 10% growth, or 30% but cyclical growth. And I think that's what we spend most of our time at the moment thinking about, because it's quite extreme. Value names that are up 50 to 100%, quality names that are 100 times. That is, pushing you in directions that you're not normally getting pushed. And that's because you do have very, very significant fiscal monetary stimulus, 0 interest rates, almost. And everyone's very, very euphoric. And I think that's what you need to be careful of right now is really valuation discipline.
Yeah, even you just saying that made me feel a bit nervous. In a recent note, you said that finding companies with pricing power will be really important in this environment. Is it possible you could take us through an example of a company with this kind of pricing power? Yeah,
so the best pricing power comes from market structures. And market structures are the number of players in the market, and also the uniqueness of what the companies within the market are solving as a problem for the world. So the best ones I can think of is Fisher & Paykel, ResMed and Philips are 3 companies. 2 are listed in Australia, ResMed and Fisher & Paykel, but Philips is the 3rd player. And these 3 players dominate in terms of sleep apnea and sleep medication or sleep application in terms of software and also hardware. And that is a very unique and very specific solution that they're providing to the world. And there's also a very deep element of trust. So a medical device, there's a deep element of trust. And that's something that may take 10 or 20 years of research so that you can get to a patient who's come out of an intensive care unit or has had a car accident or can't breathe because of sleep apnea. You need to give them oxygen. It's a very acute problem that needs to work. And the risk of that is very dramatic. So there's a very significant trust element, a very significant research and development element. And because of that, it has pricing power. But with that pricing power, you need to invest in innovation, invest in leadership, and that's really how you kind of deserve and hold your position. But that is a good example of pricing power, and that's what also gives you the duration and the sustainability of a business, and also as a stock as well, that can compound and be one of these sort of beautiful compounders that I've seen.
You talked a little bit earlier about your 3 investment pillars, which are credibility, viability and sustainability. Is it possible you could take us through an example of a recent purchase and through those investment lenses?
Yeah, so for me, watching small caps for 20 years, this is what I've learned as the pillars of success. So if you can have your high viability, high sustainability and high credibility for 5 to 10 year period, you can be an amazing investment. Viability is about returns, the level of returns, this S-curve, the market structures, etc. So it really tells you what the return level is. Sustainability is how long that return profile lasts for. Is it 1 year? Is it 20 years? Or is it more than 20 years? That comes down to customer entrenchment, again, market structures, and the competitive elements of the marketplace. And then credibility is trusting yourself, trusting the accounts, trusting management and the governance structures. And that really tells you, that's also a blow-up risk. If that credibility score is low, the duration is going to be low and potentially the blow-up risk will be high. So that's sort of where the VSC for me is really my bottom-up stock picking tool.
Yeah.
So when you go into portfolio construction and you look at picking stocks, high quality stocks have very high VSC scores. So they've got high viability, high sustainability, high credibility. And in small caps, that's typically been healthcare, technology, and also global consumer stocks. And a good example of that is Pro Medicus, which is a medical software company that images and scans and then distributes the images through hospitals and networks of hospitals. This is a business that's been around for quite a long time, but it is leading the edge in terms of how they do distribute and package software in terms of images. And it's been acknowledged by American universities, the American hospital system, etc. And it's been a really strong performer, but it is viability, sustainability, credibility, it ranks really high. So it's a very high return business. Its return on capital are in the 30s, which is very unique. Australia's average is sort of 10 to 11% returns. This is 30% returns. Sustainability is also very high because what it's doing is very unique. Its market structure is very strong in terms of its position relative. And with the tick from American universities and the medical fraternity, it's got very long duration now. So it's winning contracts on a regular basis. And then also credibility in terms of management and the accounts and also your ability to see viability and sustainability, they are also very high. So for me, that's a great business that sits across that VSC score very highly. And that for me is what you want to see when you look for a future leader.
Would you use that over something like PE ratios? I know that Pro Medicus is trading at quite a high PE ratio.
Yes.
So is it more looking at these VSC factors rather than looking at those kind of traditional metrics?
Yeah, VSC is more bottom up, how you think about return on capital, how long those return on capital last for, and then the trust factor. Whereas PEs, it looks at the earnings today or next year even. But that stock is on a very high multiple, over 100 times. Again, it's one of these medical stocks at over 100 times. So very common in healthcare, tech, and sometimes even global consumer. Is
it like paying at growth at any price?
Growth at any price can be quite dangerous. So you need to make sure there's quite a lot of cash flows, but it's also about the duration of it. So sometimes long duration businesses that are in very unique positions, you can let that high multiple sit for a while, and it needs to kind of grow into its multiple. But you do need to be careful, as I say, with quality. You don't fall in love with the stock, because falling in love with the stock and quality can be quite dangerous, because if you get a very slight earnings miss, you can get the stock halving usually. So it might be a 10 or 20% earnings miss, but there'll be a 30%, say, multiple contraction. So that stock would halve, and that's happened. The best example that I've had is Navitas, which is the education business. It was trading at around $9, and there was a significant change. One of their clients and one of their customers said, okay, we don't want you at our school anymore, we can do that ourselves. And the stock was down sort of 50% over a few months. But it was only 10% part of the earnings component. But again, that viability and sustainability dropped down. And when you do that, the multiple from high levels goes to moderate levels. And that 10% earnings, 40% multiple. It's a real shock when a quality stock disappoints you. Whereas momentum, it disappoints. It's kind of a slow fade because it becomes very popular, and then it's less popular. But a quality stock, it tends to shock you, and then it will really step down quite quickly.
You've spoken a little bit now about the volatility that you can see in these quality small cap stocks. What are some of the red flags that you look for to know when you should sell or when you should just not buy a stock at all?
Yeah, it's a really good point. So one is when you should trim or sell, particularly quality, when valuations are very extreme. So for me, that's more a valuation-driven thing. Or in quality, if you do see complacency from management or arrogance, CapEx is rising quite dramatically, or there's significant competition, which means that kind of 10 to 15 year horizon is going to be shortened, or it's going to cost quite a lot more to hold that position. That's when you need to be a bit concerned. But generally it's more with momentum and cyclicals for me when you get to peak valuations, peak earnings, peak sentiment. But blow-ups are also, the credibility is really the issue. So accounting, management and valuation are the three things, but blow-ups to zero, bankruptcies, are usually balance sheet, and the worst mistakes I've made have all been from balance sheets.
Is it possible you can take us through, I guess, the worst investment mistake you've ever made?
Yeah, the worst one was Forge. So Forge was a contractor that was doing a lot of work. It was about 10 years ago now. Was getting huge contracts, and it signed contracts with what you call liquidated damages. So there was balance sheet debt, and there was off-balance sheet debt, and then there was contracts written, which were fixed price contracts, and then basically the contracts blew out in terms of costs. But then I woke up one morning and the stock was down 85% on the open. Yeah. And that is pretty scary.
Yeah.
That is pretty scary. And that's the thing, if you own these things, and that's a momentum name, it had rising activity, lots of jobs, growth in sales, lots of sentiment, really like high activity levels in the industry. And it was a participant in that sort of momentum kind of party. But because of the contracts, because of the detail of the contracts and the risk of overruns, it basically imploded. So that's why I say, accounting is typically your worst mistakes, but then also management closely follow that. So it's really accounting and management where you need to be very, very close, listening to analysts, listening to management, reading the accounts, making sure there's no red flags in there, because that'll eventually bite. It's just a matter of time.
Okay, we've just spoken about your worst mistake. Let's talk about some of the emerging themes that you're seeing in the market.
Mm-hmm. There's a lot of new themes that are emerging. So probably the biggest ones are really in software and energy, probably the two that I'd focus on. So in software, there's really SaaS and data centers and all of those things, but also the digitization of the world, Internet of Things. That's all part of that whole technology movement for the world. And for me, when the cost of capital was a little bit higher, the world, as in businesses, households or individuals and companies, had to get more productive. And basically technology is the vehicle for global, personal and corporate productivity. So for me, technology is a massive, massive theme that I'm a big believer in, and I think will be multiple decades that it will be the trend. The other one is really EV or electric vehicles, all part of the new energy theme. So green steel, electric vehicles, zero emissions or decarbonisation. This is also another really, really big theme. And there are some exposures that you can have to that in the Australian market.
Yeah, it feels like, I guess we're a little bit behind in terms of the shifting towards this kind of climate theme.
Yeah.
Compared to Europe and the US.
Yeah, definitely Northern Europe's really, and the US is, very advanced.
What do you think needs to happen for us to, I guess, catch up to the pack?
Well, in some ways we're already there. So companies like Altium, for example, is a stock that is already in electronic design systems. So that is already there. There's also companies like NextDC and Megaport, which are in the data center environment. And then you've also got all the EV green theme with electric vehicles and lithium. One of the big ones is Oz Minerals. It's got a really strong copper gold mix, and that one, it's a very, very big deposit, and copper is one of the key things. So copper, nickel and lithium are really one of the those three big metals that are going to need to go into the electric vehicle thematic, and copper's one of the main ones. So for me, that is a good business to own longer term. Copper prices had a really strong rally, so you've got to question a bit of the momentum right now, but it is a very, very good business, and it's well run. It's got a very big resource. So for me, that's why that'll probably be one of the preferred ones.
And just finally, I'd like to end on, I guess, something that investors have to get right over the coming decade.
Valuation discipline for me would be the key. So at the moment you've got very, very cheap money, very, very low yields, very, very complacent attitude towards risk. And I think the next decade, it's not going to be for me a straight line. The markets are up, some cases in the world 20-30% above pre-COVID levels. Rates are at all-time lows. Fiscal and monetary stimulus has just come through, similar to what World War II, post-World War II was. So this will normalise in time. So for me, think about sustainability, think about valuation discipline, and for me that's probably one of the key things for definitely the next 3 to 5 years.
Well, it's been an absolute pleasure to talk to you today, James. Thank you so much.
Thanks very much, thank you.